Hello everyone, welcome to Business School 101. In the previous video, we discussed what the foreign exchange market is. In this video, we will continue the discussion and focus on the major economic theories of exchange rate determination. To understand how prices are related to exchange rate movements, we first need to discuss an economic proposition known as the law of one price. The law of one price is an economic theory that states that the price of identical goods in different markets should be the same when the price is expressed in terms of the same currency. For example, if the exchange rate between the British pound and the dollar is £1 to $2, a jacket that retails for $80 in New York should sell for £40 in London. So what if the law of one price is not complied? Let's say that the jacket costs £30 in London and $80 in New York. At this price, a trader could make a profit of $20 on each jacket by purchasing it for £30 in London and selling it for $80 in New York. However, the increased demand for jackets in London would raise the price in London, and the increased supply of jackets in New York would lower the price. This would continue until prices are equalized. Thus, prices might eventually equalize when the jacket costs £35 in London and $70 in New York. Please keep in mind that the law of one price is based on several assumptions, which include free competition in the markets, the absence of trade restrictions, and price flexibility, which means neither sellers nor buyers can manipulate the prices of goods, and prices are adjusted freely. The law of one price is generally applicable to a wide range of goods, securities, and assets. Second, purchasing power parity. If the law of one price were true for all goods and services, the purchasing power parity, or PPP, exchange rate could be found from any individual set of prices. The PPP theory states that given relatively efficient markets, the price of a basket of goods should be roughly equivalent in each country. To express the PPP theory in symbols, let $P$ be the US dollar price of a basket of particular goods, and P yen be the price of the same basket of goods in Japanese yen. The PPP theory predicts that the dollar to yen exchange rate should be equivalent to P$ over P yen. Thus, if a basket of goods costs $200 in the United States and 20,000 yen in Japan, PPP theory predicts that the dollar to yen exchange rate should be $200 to 20,000 yen, or 1 cent per Japanese yen. Every year, the news magazine The Economist publishes its own version of the PPP theorem, which it refers to as the Big Mac Index. The Economist has selected McDonald's Big Mac as a proxy for a basket of goods because it is produced according to more or less the same recipe in about 120 countries. To calculate the index, The Economist converts the price of a Big Mac in a country into dollars at current exchange rates and divides that by the average price of a Big Mac in America. According to the PPP theorem, the prices should be the same. If they are not, it implies that the currency is either overvalued against the dollar or undervalued. For example, if the average price of a Big Mac in the United States was $5 while it was 20 yuan in China, the PPP theory suggests that the exchange rate should be $1 to 4 yuan. Therefore, if $1 is worth more than 4 yuan in the foreign exchange market, it suggests that the Chinese yuan is undervalued against the US dollar. Third, money supply and price inflation. Inflation is a monetary phenomenon. It occurs when the quantity of money in circulation rises faster than the stock of goods and services, that is, when the money supply increases faster than output increases. Imagine what would happen if everyone in Japan was suddenly given 5 million yen by the Japanese government. Many people would rush out to spend their extra money on those things they've always wanted, such as big houses, luxury cars, new furniture, and name-brand clothes. There would be a surge in demand for goods and services. Car dealers, department stores, and other providers of goods and services would respond to this upsurge in demand by raising prices. The result would be price inflation. For example, imagine at the beginning of the year a basket of goods cost $200 in the United States and 20,000 yen in Japan. According to the PPP theory, the dollar-yen exchange rate should be $1 to 100 yen. At the end of the year, the basket of goods still costs $200 in the United States. However, because of the increasing money supply, it costs 22,000 yen in Japan. PPP theory predicts that the exchange rate should change as a result. More precisely, by the end of the year, $1 should be equal to 110 yen. Because of the 10% price inflation, the Japanese yen has depreciated by 10% against the dollar. In other words, $1 will buy 10% more yen at the end of the year than the beginning. Fourth, interest rates and exchange rates. Economic theory tells us that interest rates reflect expectations about likely future inflation rates. In countries where inflation is expected to be high, interest rates also will be high because investors want compensation for the decline in the value of their money. This relationship was first formalized by American economist Irvin Fisher and is referred to as the Fisher effect. The Fisher effect states that a country's nominal interest rate, lowercase I, is the sum of the required real rate of interest, lowercase r, and the expected rate of inflation over the period for which the funds are to be lent, uppercase I. For example, if the real rate of interest in a country is 5% and annual inflation is expected to be 10%, the nominal interest rate will be 15%. As predicted by the Fisher effect, a strong relationship seems to exist between inflation rates and interest rates. Now let us take one step further and consider how it applies in a world of many countries and unrestricted capital flows. When investors are free to transfer capital between countries, real interest rates will be the same in every country. If differences in real interest rates did emerge between countries, arbitrage would soon equalize them. For example, if the real interest rate in Korea was 15% and only 5% in the United States, it would pay investors to borrow money in the United States and invest in Korea. The resulting increase in the demand for money in the United States would raise the real interest rate there, while the increase in the supply of foreign money in Korea would lower the real interest rate in Korea. This would continue until the two sets of real interest rates were equalized. It follows from the Fisher effect that if the real interest rate is the same worldwide, any difference in interest rates between countries reflects differing expectations about inflation rates. Thus, if the expected rate of inflation in the United States is greater than that in Korea, U.S. nominal interest rates will be greater than Korean nominal interest rates. Since we know from PPP theory that theoretically there is a link between inflation and exchange rates, and since interest rates reflect expectations about inflation, it follows that there must also be a link between interest rates and exchange rates. This link is known as the International Fisher effect, or IFE. The International Fisher effect states that for any two countries, the spot exchange rate should change in an equal amount but in the opposite direction to the difference in nominal interest rates between the two countries. Stated more formally, the change in the spot exchange rate between the United States and Korea, for example, can be modeled by the following formula. The I dollar and I won are the respective nominal interest rates in the United States and Korea. S1 is the spot exchange rate at the beginning of the period, and S2 is the spot exchange rate at the end of the period. If the U.S. nominal interest rate is higher than Korea's, reflecting greater expected inflation rates, the value of the dollar against the won should fall by that interest rate differential in the future. So if the nominal interest rate in the United States is 15% and in Korea it is 5%, we would expect the value of the dollar to depreciate by 10% against the Korean won. Although both PPP theory and the International Fisher effect hold strong economic rationale, empirical evidence suggests that neither of them are good at explaining short-term movements in exchange rates. One reason may be the impact of investor psychology on short-run exchange rate movements. Evidence reveals that various psychological factors play an important role in determining the expectations of market traders as to likely future exchange rates. In turn, expectations have a tendency to become self-fulfilling prophecies. A famous example of this mechanism occurred in September 1992 when the international financier George Soros made a huge bet against the British pound. Soros borrowed billions of pounds, using the assets of his investment funds as collateral, and immediately sold these pounds for German Dutch marks. After Soros started shorting the British pound, many foreign exchange traders, knowing Soros's reputation, jumped on the bandwagon and did likewise. This triggered a classic bandwagon effect, with traders moving as a herd in the same direction at the same time. As the bandwagon effect gained momentum, with more traders selling British pounds and purchasing Dutch marks in expectation of a decline in the pound, their expectations became a self-fulfilling prophecy. massive selling forced down the value of the pound against the Dutch mark. In other words, the pound declined in value not so much because of any major shift in macroeconomic fundamentals, but because investors followed a bet placed by a major speculator, George Soros. According to a number of studies, investor psychology and bandwagon effects play a major role in determining short-run exchange rate movements. However, these effects can be hard to predict. Investor psychology can be influenced by political factors and by macroeconomic events, such as the investment decisions of individual firms, many of which are only loosely linked to macroeconomic fundamentals, such as relative inflation rates. Also, bandwagon effects can be both triggered and exacerbated by the idiosyncratic behavior of politicians. Something like this seems to have occurred in Southeast Asia during 1997 when, one after another, the currencies of Thailand, Malaysia, South Korea, and Indonesia lost between 50% and 70% of their value against the US dollar in a few months. To sum up, the law of one price, purchasing power parity, and international Fisher effect are all moderately good predictors of long-run changes in exchange rates. However, they are poor predictors of short-run changes in exchange rates. Perhaps this is because of the impact of psychological factors, investor expectations, and bandwagon effects on short-term currency movements. The movement of the international exchange market is very complicated to predict because it is influenced by so many different factors. International business practitioners should pay close attention to the changes in markets and understand all the available financial instruments to avoid the unnecessary loss. So, what do you think about the foreign exchange market? Please leave your thoughts in a comment below. If you enjoyed this video, then please be sure to give it a thumbs up and to subscribe to the channel. Thanks for watching, and I will see you next time.